And now I'd like to welcome our next presenter. She's known as the Resource Maven. You may have seen her earlier at PDAC or the VRIC conference or any of the other Cambridge House events, or maybe even checked out her newsletter. That is called the Resource Maven, is that correct? At maven.ca?
Resourcemaven.ca, yeah.
Resourcemaven.ca. So Gwen, you've been in the business for well over 15 years, both on the technical side and more now on a journalistic kind of side. You bring a very interesting slant to these types of talks, and just wondering what you're going to talk to us today about.
I mean, talking about how to structure your portfolio for what I think is an exciting bull market that's coming, that's underway already, and how to approach building a portfolio to take advantage of that.
Perfect. That sounds great. I will leave you to it then.
Well, thanks so much. And thanks everyone for participating and for the opportunity to present. I'm just going to bring up my slides here. And there you go. There you have it. Just as I said, I wanted to talk about building your junior mining portfolio. Now, building a portfolio of stocks in any sector has to start with a decision that sector is on a good, strong, like a bullish fundamental footing, right? So I don't want to spend a lot of time on these points because there's lots of other talks, even here and at PDAC in general, about sort of the macroeconomic picture. But briefly, what do metals need to perform? Well, they need strong demand, ideally against weak supply. It is better for a metals bull market if the US dollar is weak, because a strong US dollar is a headwind. For gold, we need negative real interest rates. And we need investors to pay attention to real rates instead of nominal rates, which isn't what's happening right now, but that's coming, and that's a necessity. And we need a reason for investors to be interested in this space. And as you can see from my very well drawn check marks, I do believe that all of these points are met. Now, I'm not going to go through them all. The first one was strong demand against weak supply. We certainly have strong demand for base metals as we go into this recovery. There's infrastructure programs everywhere. We're in a growth phase, so we certainly have strong demand. Supply on the metal side, I mean, going through each metal would take an hour on its own, but we generally have strong demand against weak supply in copper, in nickel, in silver even, and that's why the prices for base metals in iron ore have been going through the roof. The second point that we needed for gold is negative real interest rates. They are inarguably the most important bull force for gold. This is the 10-year Treasury inflation index. So this is the yield corrected for inflation. So it's a great proxy for real rates. And you can see that they were doing their thing. They've been doing their thing since this bull market started. They fell. That kicked off the bull market in 2016. They rebounded through 2017 through 2018. That hindered the gold market. They were declining quite nicely through 2019. That's when gold was starting to get its own footing. And then bam, COVID hit and real rates were slammed into negative territory, and they will stay there for a long time. In fact, they will likely go lower as inflation shows up. And the reason for that? Well, the Fed keeps telling us that they're not close to raising rates. And I know yields have risen in the last few weeks, but I still believe the Fed when they say they're not close to raising rates, because they are nowhere close to the goals that they need to be at to raise rates, which is right now we have unemployment at 6.7% and core inflation at 1.5. The unemployment needs to be way lower and the core inflation needs to be way higher. So I don't think we're going to see interest rates go up anytime soon. And that means that we're definitely in a negative real rate environment. Now, I referenced investors also have to care about real rates, and that's the little bit of a hindrance that we're in right now. And the reason that that's happening is that inflation uncertainty has investors currently focused on nominal rates. So just like what the 10-year is yielding, not corrected for inflation. They're focusing on nominal rates instead of real rates. I think they're doing that because it's difficult to forecast inflation. I think there's a huge expectation that inflation is coming, but it's very unclear how quickly it will take hold, like when it will take hold and how quickly it will ramp up. And fair enough, we're in pretty uncharted waters these days with the monetary and fiscal programs that are underway and recovering from a global pandemic. So I get that inflation is hard to forecast, and I think that's why people are focusing on nominal rates. Nominal rates are rising because money is rotating out of bonds to get away from that inflation worry into stocks because we're going into a recovery. It's also rotating out of bonds because there's so many bonds. The bond issuances this week have not done well because guess what? There's a lot of bonds out there. There's no shortage of supply. So prices of bonds are going down, yields are going up, and that's negative for gold. At some point, focus will shift back to real rates and that will sort of take care of itself. But for now, we're in a bit of a lull there because people are focused on these nominal rates that are rising. Then if you want to add in gold seasonality, which is that it's weak from March through June, there is a near-term risk for gold. And I'm not a genius for saying that. We have been experiencing it for quite a few weeks now. And I think that what I'm saying is I think it will persist for a little while because there's not a lot of forces lined up specifically in support of gold. But I want to take a step back. And I said that the factors for a broad metals bull market are strong demand against weak supply, check. Negative real rates for gold, check. In time. I mean, the negative real rates are there. We just need investors to care a little bit more. A weak US dollar, I think we are in a weaker US dollar paradigm now than we used to be. So I think that condition is met. I could also say it as I don't think a really very strong US dollar is going to prevent a metals bull market. Then the fourth thing I said that's necessary is a reason for investors to be interested. And this is sort of the equation that I have for that. There's reason for base metals to go. There's lots of demand. There's not enough supply. The fundamentals for gold are there. There's inflation coming. There's risks in the stock market. There's the fact that metals all run together. It all adds up to the fact that metals and miners just make sense. In fact, they make a lot of sense. And this is one point that I've been speaking to in every presentation that I make these days, because I think it's really important. Miners, and it's gold miners, but it's also silver miners and copper miners and nickel miners. It works for all of them. They stand out across equities right now for their balance sheets, for their free cash flows, and for their dividend yields. They are kicking butt. Scotiabank, this was a few months ago, calculated the average yield of the mid-tier and major gold miners in their coverage universe, 2% dividend yield. That's way above the S&P 500's average of 1.6. And importantly, those miners, their dividends are just going up, up, up. A whole bunch of the majors have pegged their dividend yields to incremental free cash flow. And that bar chart on the right there shows you that incremental free cash flow is ramping right up. So anybody who's out there who wants some diversification against the risks of the stock market, we're in very high valuation territory, who wants fundamental financial strength, miners stand out in that sense. So I think there's a lot of reason to believe that we are going into a significant metals bull market. If you believe that, then the question is, how do you position your portfolio for that opportunity? And instead of just giving you an answer, what I have to do is turn the question back on you. Metals bull markets, the basis of what I'm about to say is that metals bull markets generate really great investment returns across the risk spectrum. So on one end, you have, pre-discovery exploration stocks, where a lot of them fail, but the ones that succeed shoot right through the roof, right? And that's what people get tantalized by. That's an exciting thing. But this is a hard investment arena, and I'm going to go through that in a moment. On the other side of things, major miners see their share prices multiply in metals bull markets. So where you should sit on that spectrum depends on you. And that's what I've tried to summarize a bit here in this table. So, these are some of the factors that are involved. Juniors, I mean like pre-discovery explorers. Bigger juniors, those with a resource, maybe pushing it towards mine plan, growing the resource, maybe in permitting, and then miners. Risk obviously increases or starts really high. Pre-discovery explorers, super high risk. The risk is lower, but definitely still present for those bigger juniors. And it's quite low for miners. The main risk on the miners with miners is the metals price environment. So if you're bullish there, that's the main risk in miners. In a very related vein, the next line is really important. How much do you need to follow the news that a company issues and react to it, perhaps trade on it? And the answer is that if you're going to play pre-discovery explorers, you need to pay attention to every press release, every single one, and you may well have to trade them. So that is a commitment. You can't, there's the potential to make lots of money if you do that. There's also the potential to lose lots of money because risk cuts both ways. But that's a requirement. If you're going to play the small end of the spectrum, the pre-discovery explorers, or the just made a discovery and trying to figure out what it is, you need to pay attention to all of it. With the bigger juniors, not so much. If they've already got a resource, they're pushing it towards a mine plan, you need to be aware of key events and have a theory about how that might impact a share price. But you don't need to, you don't need to open your computer every morning and see if they issued a press release. And with the major miners, no. At the end of the day, you don't need to follow their news at all. You've bought them as leverage to a metal price, not because of the stock itself in particular. So that's almost the most important. How much do you want to pay attention to your portfolio on a daily basis? If the answer is that you don't, you should be over on the miners side of things. If the answer is that you do, then maybe the juniors are for you. Also, another consideration is how many stocks do you want to own? A lot of explorers don't work. If you have a really strong metals bull market, then a rising tide lifts all ships to a certain extent. But at the end of the day, you play juniors to get that, that major discovery that sends a share price through the roof. What are the odds of getting that? They're not super high, which is why you need to own a lot of stocks. If you're not comfortable owning 30, 40, 50 stocks, then juniors probably aren't for you because you need that many to increase your odds of hitting one way out of the park. The bigger juniors, you don't want to own just one because there are still risks around jurisdiction, around permitting, around sort of the commodity or the stage of development. So you want to own several. You don't need to own 40, but you want to own quite a few. And then on the miner side, again, you can just own a few, or you can own a single fund that covers, larger miners, and that covers your bases. Then there's also a difference for when each of these categories performs in the course of a metals bull market. Discoveries perform when they happen, so you can't predict that timing. And as for the bigger juniors, usually that's the middle of the cycle. That's sort of when things are getting going, and there's increasing talk about how the bigger operators are going to need to buy the good projects. That really boosts interest in those operators or those explorers who have projects that are starting to look really good. And then on the miner side, they often perform early in the cycle. Like in 2016, gold miners kicked it, like they were so good. And then they often perform again later in the cycle as their cash flows become undeniable. So the last line is maybe helps you balance some of your interests a little bit, but the other three lines are really important. How much risk do you want to take on? How much time do you want to spend paying attention to your portfolio? And how many stocks are you comfortable owning? So this is I'm just going to go through a few of these things a bit more. I'm almost done, but you really need to know yourself. If you don't want to trade daily, watch news, stay abreast of pressures and catalysts for every stock, don't buy pre-discovery explorers. This is GT Gold. I mean, GT Gold has made a great discovery over the last few years, but you can see how volatile that share price chart is, right? And so you need to, and this isn't just based on drill results. I can promise you that a bunch of the ups and more significantly, a bunch of the downs in that share price chart have to do with financing pressures and seasonality and other factors that you need to be aware of if you want to trade a stock like that successfully. So don't get into this space if you think you're just going to enter and then it's going to go up and you're going to sell because it's harder than you think. You really need to invest a lot of time and focus to do that properly. So if that doesn't work for you, but you want a little bit more leverage than just a mining company offers, then you can consider developers. So the chart here is for pure gold mining. They spent the last year building a gold mine and they got significantly re-rated, as they should. The re-rating from when a company goes from, planning a mine to actually building and then producing from a mine is about 100%, often more. So that's what we call the golden runway, and it's a very reliable one. So that is an interesting arena that you can consider if you don't want to trade on a daily basis, but you want a little bit more going on. If you're bullish on commodities, but you don't want to follow individual stocks and you don't want to bear much risk at all, then own funds of major miners. This is the VanEck Gold Miners ETF, the Global X Copper Miners ETF, the iShares Global Material. I'd use that sort of as a proxy for nickel. Guess what? they've done really well in 2020 and up till today. So I'm saying this to hammer home the point that miners perform across the risk spectrum in a good market. Don't feel that you have to play the the risky game of the juniors. Build a portfolio that works for you. And then if you are okay with super high risk and you want to commit the time and focus and you're looking for those multi-bagger stocks, absolutely build a portfolio of junior explorers. The two points that I would add to that is, as I said previously, you have to own lots. Don't just own one or two, because you're not setting, the odds are not in your favor if you only own one or two. And then I would say, don't try and do it alone. Find a team, find an online community, find newsletter writers, find some brokers or a broker who you really like to track these stocks. It's a huge amount of information to track and understand. So try and find some people who you can share, with whom you can share the burden. I just have two share price charts here. And I've just noted some of the factors that move these share prices around. On the left, we had one that was a stock that had been asleep, a tiny junior stock that had been asleep doing nothing for ages. It awoke from its slumber and its share price ran up, 300% or 150%. And then there was some disappointment around permitting and a need to finance, and then it financed and everybody got excited again. And then guess what? The permits still haven't come through. It's still not even drilling, let alone had any results out. And this is what the share price chart has done. These things are volatile. On the right is another company where the share price jumped dramatically, but on a discovery, but it wasn't a discovery really, if you knew geology and what to assess. And so guess what? Then there was a bunch of marketing on that discovery that wasn't really a discovery. And then there was the impact of marketing, and then there was seasonality. They couldn't explore in the fall time. The share price comes off again. Then there's just reality sets in. These things are complicated, is the takeaway there. So just be a little careful. I'm going to wrap up quickly here. Timing is everything. Short-term predictions are the hardest to make, but they're important because it's always better to enter on a dip than on a peak, obviously. And because selling risk management is absolutely essential in the high risk end of what I've been talking about. Selling some into strength and buying more during weakness really amplifies your odds of success. I said it before, I'll say it again. Precious metals are usually strong through February, and then they're not so strong through the summer. So I really do think that there's some near-term risk ahead. I think it's a bit boring for the next few months. So what do we do right now? I think you make sure you have coverage, that your portfolio has good coverage on the base metals side. And I would probably include silver in that because it's considered more industrial right now than precious. I would say that I'm not super bullish on gold for the next month or two. I think that it will start to pick up again in the summer, but I don't think it's going to be very exciting from here because we need that inflation question to get a little bit more answered before real rates start rearing their heads again. And as I mentioned once before, discoveries don't follow patterns. I lay out these patterns, but discoveries happen when they happen, and they send share prices soaring when they happen. So even though gold has a seasonality and we can buy and sell based on that seasonality, on the explorer side, you have to buy a stock based on its schedule, when it is doing something and when its results are expected. There's a lot of forces out there that push junior share prices around. I've listed some of them, like the need to finance, financing coming free to trade, when a group can explore their projects if they're up in the frozen north, of course, what results they get. So it's not just the numbers that come out of the ground. There's lots of forces. So be aware of those forces when they fit where they fit on the calendar, and try and time your buys around some of that. And with exploration stocks, I say that's an odds game again. A very clear plan for what they're going to do with your money to try to create value, and clear technical and capital markets expertise. They have to know the rocks, and they have to know how to raise and deploy money. And those are different tasks that are equally important in the junior exploration. What I offer, my website is resourcemaven.ca. We offer 4 newsletters. The 2 that I write are in red. The Maven letter is the weekly letter of what I'm buying, selling, and thinking in the high to medium risk part of my portfolio. The premium service is for those who are interested in participating in financings. I secure a large enough allocation that premium subscribers can participate alongside myself when I invest in a financing. And then I have another writer in the team, Peter Kraut, and he writes Silver Stock Investor, a monthly letter on all things silver, and Gold Resource Investor, which helps less experienced investors learn the mining ropes and has low risk buys and sells. Importantly, we're independent, we're supported by subscribers, and we don't take money from companies for coverage. So it's just about what we're doing with our money. And with that, thank you so much for your time and attention and for having me here.
Oh, thank you very much, Gwen. So I have a couple questions for you. You did mention online communities. You mentioned sources of information. Now, I know we had the big GameStop thing, the Reddit board that happened and is still happening. In light of that, in light of, I wouldn't say the easy ability for anyone to raise money right now, are these things making your job in analyzing these trends and these companies harder, easier? Is there just a lot of noise out there? How do you cut through that noise? What do you have any tips or tricks that you can give people?
So that's an really interesting question. It's sort of a whole ball of wax to unpack there. Stepping back, the bigger picture is that 10, 15 years ago, most investors in the mining space got their information from a broker. And that conduit has largely broken down. I mean, I certainly work with my broker, but there's a huge number of retail investors out there who barely know what a broker is. They have online trading platforms. And so that used to be a key pathway for information. For better or worse, brokers have, there's good brokers and bad brokers, and some are motivated only by their clients' well-being and others by other things. But regardless of the pros and cons of it, that conduit is largely broken. And so investors have had to come up with different ways to get their information. And so, and companies have had to adapt to that as well. They can't just market to the banks and the brokers, they have to market directly to retail. So it's been a challenge for companies to come up with ways to engage effectively, efficiently, but fully with whatever audience is out there, to find that audience. There's also certainly, there's a huge range in the online community. There's so many chat rooms and bulletin boards related to junior mining investing. There is some really quality stuff out there, no doubt. There's some very, very smart people out there posting credible, useful information on those boards. And then, of course, there's a bunch of people out there who have their own interest in mind. They're not necessarily trying to help others or participate honestly in that discussion. They're trying to call it pump a stock or whatever it is. And so you just have to be careful. I would say the only takeaways that I can give that are broadly useful are, if you get something that looks like a newsletter, always read the disclaimer. Figure out whether the company paid for that to be said. It has to say in the disclaimer whether a company paid for the analyst or writer, whoever it is that's presenting the article, whether the analyst or writer got paid for it by the company. If they did, take that for what that is. It's a piece of marketing, right? Because the company paid for it. If the writer did not get paid, then then the motivation there is likely more honest. And that's certainly the path that, a key distinction that I put out there. And other than that, I would say if you find a group that's good, that's helpful, that's great, stay in it, but don't let yourself dive too deep, because sometimes these communities can kind of like pull you down a wormhole and they go where they go. They might get a little bit too focused on this or on that and miss something else that's going on. So try to have multiple sources of information. And I mean, newsletter writers are out there. The reason newsletter writers have to some extent filled the role that brokers used to play. And if you find someone who is truly, on your side, helping you assess stocks, then that's a really useful person to be able to send a question to every now and then. I certainly try and reply to every question that comes to my inbox to try and help people navigate these difficult waters.
Well, perfect. And I think, you've been a credible source for news for a while now. So why don't you give us the website one more time?
So it's resourcemaven.ca, and there's Lots of opportunity. There's places there where you can sign up for free trials for any of the newsletters if you happen to be interested in taking a look at what we produce.
Perfect. Thank you, Gwen. We have a lot of junior exploration companies. We have a lot of people who are just, investors or just interested in the junior resource space. So hopefully some of them have found this useful today, and maybe they head on over to your site and check your newsletter out. But in any case, it was a pleasure to have you here and talking about these things. And I know that I'll use some of that advice when I look at my next investment. Thank you.
Perfect. Thank you so much for having me.
All right. Thanks, Gwen. Bye.